So, let's talk about the insurance brokerage giant Arthur J. Gallagher, or AJG. For decades, this company perfected a really reliable, almost boring growth formula that turned it into an absolute powerhouse. But then they decided to risk it all. They bet the entire house on one massive, company-altering deal. The question is that bet about to pay off or blow up in their face?
And when I say a massive deal, I am not kidding. $13.45 billion. That's the price tag for AssuredPartners, the single largest acquisition in AJJ's nearly 100-year history. You know, a number this big, it fundamentally changes everything about a company. And as an investor, you have to ask yourself, is this a brilliant masterstroke or a catastrophic risk? To really get the stakes here, we first have to understand how AJJ's business actually works.
So how does AJG actually make its money? Well, it's pretty simple, really. It's broken into two main parts. The real engine of the company, bringing in almost 90% of the cash, is brokerage. Think of them as a matchmaker between businesses that need insurance and the companies that sell it. The other slice of the pie is risk management. But honestly, for our story today, everything, and I mean everything, revolves around that core brokerage business.
And believe me, that engine is powerful. AJG has grown and grown to become the third largest insurance broker on the entire planet, right on the heels of the industry titans Marsh & McLennan and Aon. Now, a global footprint like this, it doesn't just happen by accident. It was built very deliberately, using a very specific and repeatable formula for growth.
All right, so let's pull back the curtain on that formula. What exactly made their model so successful for so long, and what on earth gave them the confidence to make this enormous bet?
This, right here, is why investors absolutely love the brokerage business. For most companies, insurance isn't a nice-to-have, it's a must-have. You just have to have it to operate. This creates these incredibly sticky client relationships with revenue that's highly predictable and comes in year after year. Clients just rarely switch brokers, which makes the whole business remarkably tough and resilient, even when the economy gets rocky. It's just a consistent cash flow machine.
Now, the industry does have its own rhythm, its own cycle. You have hard markets where insurance premiums are on the rise. That's great news for brokers like AJG because their commissions, which are a percentage of those premiums, go up right along with them. Then you have soft markets, where competition heats up, premiums fall, and that puts a squeeze on growth. Lately, parts of the market have been pretty hard, and that's been a nice little tailwind for the company.
But the real secret sauce to AJG's growth for all these years is this number. They have completed over 582 acquisitions. Just let that sink in. They are absolute masters of consolidation, buying up smaller, local brokers and just plugging them into their massive global platform. This M&A conveyor belt has been their core strategy for decades. Well, until now. And this brings us to the main event, the centerpiece of our story, that monumental acquisition of AssuredPartners. This is the moment where AJG took their proven formula and cranked it up to a completely new and way, way riskier level.
I mean, this quote from analysts really just says it all. Instead of continuing their steady pace of hundreds of little deals, they decided to take one giant leap. This single transaction was designed to do in a moment what would have otherwise taken them decades to build, instantly changing their place in the market.
So, what was the thinking here? The logic behind the bet was actually crystal clear. The deal massively beefs up their core U.S. business. It adds some really valuable expertise in lucrative areas like transportation and healthcare, and, this is the big one, it gives them the scale to go toe-to-toe with the two giants of the industry. So from a strategic point of view, it looks powerful. But here's the thing. Strategy and finance can tell two very, very different stories.
And that's where we get to the other side of this story. Because for every massive bet, there's a massive risk. And when you start digging into the numbers behind this deal, some pretty serious cracks start to show up in the foundation.
And this right here, this is the billion-dollar question that every single shareholder should be asking. You know, it's great to get bigger, but is all that growth actually creating value? Is the company becoming more profitable, more efficient? Well, the data is raising some serious red flags.
First up, let's talk about the debt. Just look at this jump. To pull off this deal, AJG's total debt skyrocketed by over $5 billion in a single year. That is a huge increase in financial leverage, and it makes the company far more vulnerable to things like rising interest rates or any unexpected hiccups in its business.
And second, there's this really worrying trend. As the company gets bigger and bigger, key measures of profitability, like return on equity and return on invested capital, are actually going down. This suggests that all this massive amount of money they're spending, well,
it's generating lower and lower returns. And that brings us to what might be the most critical point for any investor looking at this company.
Okay, this next part is maybe the most important concept for anyone investing in a business. It all boils down to this simple, kind of brutal math. The company's return on invested capital, that's what it earns on all its investments, is sitting around 5.4%. But its cost of capital, what it has to pay for that money through debt and equity, is higher, at about 6.4%. And when what you earn is less than what you pay, you are, in economic terms, destroying value, not creating it.
So where does this all leave us? On one hand, you have a proven growth machine making a super bold, strategic bet. On the other hand, you have some very real financial risks staring you in the face. So let's pull it all together and see how the market is pricing this high-stakes story.
Looking at the valuation, wow. The stock market seems to be siding firmly with the optimists. On key metrics like the price-to-earnings ratio, AJG is trading at a massive premium compared to its competitors. The market is basically saying, we believe this is going to work out perfectly, and it's pricing in a huge amount of future success right now.
So the bull case, the optimistic story, it goes something like this. You're betting on a management team that has an incredible track record. You believe this huge deal creates a much stronger, more competitive company, and that its super durable business model will power through any challenges to deliver much higher earnings down the road.
But then there's the bear case, and it is just as compelling. The risk of integrating a company this huge is off the charts. The balance sheet is stretched incredibly thin. The numbers, right now, suggest the company is actually destroying economic value. And that premium valuation we just talked about, it leaves zero, and I mean zero, room for error. Any slip up, and this stock could fall hard.
So, as an investor trying to figure this out, what should you be watching? I'd keep an eye on 4 key things. First, organic growth. Are they growing without just buying companies? Second, profit margins. Are those promised synergies actually showing up? Third, and this is the most critical one, that return on invested capital. Can they get it back above their cost of capital? And finally, are they successfully paying down that mountain of debt? Ultimately, it all comes down to this single question. The market is betting that AJG will execute this massive, complicated deal flawlessly. It has priced the stock for absolute perfection. The question you have to decide is whether this decades-long M&A machine can actually deliver on what is, by far, its biggest and most audacious bet ever.